Hello everyone, hi, welcome to the channel of Wall Street Mojo. Friends, today we are going to learn a tutorial on cost of equity, which is used in the capital asset pricing model, which is known as CAPM, a formula, and we'll be learning some of the examples of the same. At the very first end, what you can see the cost of equity of various companies like Alphabet, Facebook, Yahoo, Twitter, VeriSign, Yandex, Sina. So the cost of equity of Yandex is the highest, that is 18.70, and Facebook is having the lowest cost of equity. Highest is really bad, higher is really bad, lowest is really good. So what is exactly the cost of equity? The cost of equity, that is, which is known as KE, in a very short way, the cost of equity is one of the most significant attributes that you need to look at before you think of investing in any company. Let's look at the graph, above that, which we saw. The cost of Yandex is 18.70, while that of the Facebook is just 6.30. So what does this exactly mean? How would you calculate it, and what metrics do you need to be aware of while looking at KE? Let's start. First, let's learn exactly what is KE. Cost of equity is an important measure for investors who wants to invest into company. So the cost of equity is the rate of return which an investor would require from the stock before looking into the viable opportunities. So if we can go back and look at the concept of opportunity cost, we'll understand it better. Like suppose, let's say you have $1,000 to invest. So you look for many opportunities and you choose one of the best which according to you would yield more returns. Now as you decided to invest into a particular opportunity, you would let go of the others, maybe more profitable opportunities, and that loss of other alternative is called as opportunity cost. Let's come back to our KE. Now KE, if you as an investor don't get better returns from the company A, you will go ahead and invest in other companies, and the company A has to bear the opportunity cost if they don't put their effort to increase the required rate of return. I'll give you a hint. Pay the dividend and put the effort so that the share price appreciates. Let's take an example again to understand this. Let's say there's this guy called Mr. A. He wants to invest in company B. Now, but as Mr. A is relatively a new investor, he wants a low risk stock which can yield him good return. So company B's current stock price is, let's say it's trading at $18 per share, and Mr. A expects that the required rate of return for him would be close enough to more than 15%. I'll just write over here Control V, Control X, and Control V. So yeah, and through the calculation of the cost of equity, he'll understand what he will get as required rate of return. If he gets 15% or more, he'll invest into the company, and if not, he will look for some other opportunities, not B then C, right? So let's understand the cost of the equity formula in CAPM and dividend discount model. First, the cost of equity formula in the dividend discount model. The cost of equity in case of dividend discount model is as simple as that. The dividend that has been paid, that is the D, for the next year. So 1 plus G, that is you add the growth rate, divide by what? The current market price, that is known as your P0, right? P0 is your current market price or current market value of the stock, plus you add the growth rate of the dividend on this. So you will add the growth rate of dividends. So here it is computed by taking the dividends as per the share into account. So here, example would really suit us better. Let's say Mr. C wants to invest in Berry Juice Private Limited. Currently, Berry Juice Private Limited has decided to pay $2 per share as dividend, let's say. And the current market price of the stock is, let's say, $20. So Mr. C expects that the appreciation in the dividend would be around close enough to 4%. A guess based on the previous year's date. So the K would be close enough to 14%. How would you calculate the growth rate? We need to remember that the growth rate is the estimated one. We need to compute it in the manner. So if we are not being provided with the payout ratio, that is the payout ratio, if we are not given with this and the return of the equity, we need to calculate it. So how do we calculate the dividend payout ratio? Dividend payout ratio. So dividend payout ratio is calculated as the dividend divided by the net income. We can use another ratio to find out the dividend payout ratio, which is alternative way, that is the DP ratio is basically 1 minus the, you can say, the retained earnings divide by, you can say, the net income, which is your retention ratio. The return on equity is the second thing, that we ROE can be calculated as is equal to your net income divided by your total equity. Now, the next thing, how to calculate the cost of equity with the help of the CAPM method. CAPM method. Let's get into this. CAPM quantifies the relationship between the risk and the return in the well-functioning market. Cost of equity as per the CAPM method is as follow. I'm just trying to figure out, is equal to, is basically your risk-free rate RF plus beta, which is the sensitivity of the stock, that of the market, and you'll be multiplying this with the risk of the market less the risk-free rate. Once you do this, you get the cost of the equity. Over here, the risk-free rate, this is basically the return of the RF, is the return of the security that has no default risk, no volatility, and beta of 0. 10-year government bond is typically taken as risk-free rate. The second over here that we see is beta. Beta is basically the statistical measure percentage of the variability of the company's stock, you can say, price in relation to the stock market overall. So if the company has high beta, that means the company has more risk, and thus the company needs to pay more to attract the investor. That means that, more KE. And then you have RM, that is a risk premium, RM minus RF, which is your risk premium. So it measures of the return that equity investor demand over the risk-free rate in order to compensate them for the volatility of the risk of an investment, which matches the volatility of the entire market. So the risk premium estimates the vary from close enough to, it varies 4 to 7%. Let's take an example to understand this. Let's say the beta of the company, I'll just write the data of the company is, let's say, 1. The risk-free, that is the RF, which the risk-free rate, let's say it is 4%. The market rate of return, that is risk RM, is let's say close enough to 6%. So we need to compute the cost of the equity using the CAPM model. Let's say company M has a beta of 1, and that means the stock of the company M will increase or decrease as per the tandem of the market. So we'll understand more of this in the later section. KE basically is equal to RF, that is your 4%, is equal to your 4% plus 1 into 0.06 minus 0.04, and that will give you your final answer, which will be close enough to 6%. So what is the interpretation of the cost of the equity? The KE is not exactly what we refer to it. It's a responsibility of the company. It is the rate which the company needs to generate to allure the investor to invest in the stock at the market price. And that's why KE is also referred as required rate of return. So let's say an investor, you don't have any idea what is the KE of a company. What would you do? First, you need to find out the total equity of the company. This is the first thing. If you look at the balance sheet of the company, you would find it easily. And then you need to see whether the company has paid any dividends or not. You can check their cash flow statement to be ensured. If they pay a dividend, you need to use dividend discount model, as we have discussed above, and if not, they need to go ahead and find out the risk-free rate and compute the cost of the equity under the CAPM method. Computing it under CAPM is tougher job, as you need to find out the beta by doing regression analysis. Now we'll discuss what are the limitation of cost of equity. See, there are a couple of limitations that we need to consider. The first is that the growth rate can always be estimated by the investor. The investor only can estimate what the dividend appreciation was in the previous year, and then he can assume that the growth would be similar in the next year. Second, in the case of the CAPM, for an investor, it's not always easy to calculate the market rate of return, that is the RM, and the beta. So, in the final analysis, as a part of the conclusion, the cost of equity is a great measure for an investor to understand whether to invest into a company or not. But instead of looking at just this, if they look at the WACC, which is known as weighted average cost of capital, that would give them a holistic picture, as the cost of the debt also affects the dividend payment for the shareholders. Thank you, everyone.